everyone. Welcome back. I am Joe Gallimore, Director of Investment Management with Archer Bridge Advisors. Welcome to another Cup of Joe. So stock markets cooled off in August. The S&P 500 retreated about 1.6%, but still sits above 18.5% for the year. Riskier assets such as U.S. small cap stocks and emerging markets, those were down more. And even the bond index ticked down about 0.5% as interest rates rose a little during the month. Now, this August decline seems to be not such a bad thing. Certainly not a good thing per se, but good in the sense that it may be healthy for the stock market. Staving off that proverbial rational exuberance we've heard in the past and keeping everyone's expectations in check. By that I mean, through July 31st, the S&P 500 was plus 20.6% return for the year. That was on pace for a calendar year return of 35.5%. That's huge. That has only happened 5 times since the Great Depression, with the last time being in 1958. So if that had played out, that would have been exceptional, especially when you consider that we're kind of staring in the face of a widely expected economic slowdown. Now, in my opinion, one good thing about this market repricing in August is that it seemed to happen on its own. It wasn't really caused by any surprise headlines or any negative economic reports that came out. It just kind of happened by the market participants. Chalk it up to profit taking or investors adopting a wait and see mentality. It just happened organically. And this August cool off also happened with a very average amount of volatility, at least average by historical standards, except for a tiny 3-day period right in the middle of the month where things got a little spicy. The daily moves were mostly in bite-sized chunks, and I think that was nice to see. An additional benefit of this may also be that a benefit for our collective investing mentality and individually, because modest day-to-day moves tend to keep the financial media quiet. And that is very good for keeping our fear reactions and our FOMO reactions from flashing red. So what we experienced in August, the market kind of moderating itself on its own, isn't always a bad thing because it keeps those expectations in check and it mitigates the amount of emotional frenzy that we experience along the way. Back to the economy for a second. What this August performance could also be signaling is that the Fed is certainly still in the driver's seat here. You kind of got the sense that market participants were watching the data roll out and trying to gauge the potential signaling of, if you give a mouse a cookie, will it end up with the Fed hiking rates more, or at least pausing for a while? So, and the market participants are still watching economic data closely for any evidence of slowing. So how the final third of the year here shapes out is, it's very hard to tell at the moment, but we here at Archer Bridge, we're certainly prepared for most likely scenarios and a range of scenarios. And a big reason for hope right now is that the job market has remained exceptionally strong. The unemployment rate has remained low, and employed workers, that fuels spending. Spending fuels the profits, and corporate profits are the biggest long-term driver of stock prices. So we hope everyone had a wonderful summer. It's about to be fall. That is my favorite season, so I'm excited. But we all look forward to a prosperous Q4 and beyond. Let us know if you have any questions at all. Feel free to contact any one of us here at Archer Bridge. Thank you.